welcome to Money News on Newsmax TV. Back with us again is Todd Horowitz, Senior Strategist for Adam Mesh Trading Group and the author of Average Joe Options. Todd, it's great to be with you again.
Thanks, John. Thanks for having me on. Nice to see you or hear you.
No problem. Well, the Federal Reserve last week ended quantitative easing. At first, the markets liked the call, but will this do anything to spur any substantive recovery and ease unemployment?
You know, John, I don't think so. I think that this was, first of all, the news was definitely expected based on a 13% rally that we had during the summer. Now we finally peaked up, and obviously today a little bit softer in the market. But, you know, this is a question that's going to plague a lot of people. And the question is how many mortgage-backed securities do I own? And does it really benefit the average American? And I don't think so. I think this is just more fluff, more kicking the can down the road, more we're trying to hide from the problem, helping the banks clean up their toxic assets. So in the long run, I don't think this is going to be helpful to the markets.
Now, as you've pointed out in the past, the Fed intervention has done nothing really to help small companies get the financing they need. Now, did the Fed's recent decision do anything to prompt banks to lend more to small businesses? And also, is there even demand for financing with the economy kind of leveling off?
Well, there's certainly demand for financing because most of the companies you'll find in the Russell 2000, they need funding. They need money to make payroll. They need money to buy inventory. I do not believe that this has at all helped the small to moderate business. We are still in what I would call a liquidity lock, where banks are not willing to loan to individuals or small businesses. I think that what we're looking at here is a way that Bernanke is taking the banks and helping them get rid of all of their bad debt and allowing them to borrow money at zero and then lock it back in to the Fed, to the Treasury bonds, and get guaranteed by the full faith and credit of the United States government. So I don't think that this is all helping it whatsoever. I think this is in my opinion, this is not a good move.
Now, when the Fed eventually does decide to wind down the printing presses, is there any way to avoid a spike in the inflation rate?
You know, I think we're going to see that, but I think that inflation actually, you know, as long as it's not hyperinflation, I think we need a little bit of inflation. You know, the biggest concern in markets is deflation. So I think a little bit of inflation won't be bad. Now, for example, today we're getting a little bit of a crack in the commodity space, but I think that they're pretty much held where they're going to be. So I think a little bit of moderate inflation will not be a problem. I think if we get hyperinflation, that will then cause a problem. But I do believe that the Fed does need to stop with the easing policy and start to actually raise rates a little bit instead of trying to keep them so low, so that they can allow the banks to make that bigger spread that they want to make, so that will then increase liquidity to the average American.
We'll talk about commodities in just a second, but I want to ask you, what do you think will have a bigger impact on the dollar moving forward, the EU debt crisis or the Fed's monetary policy?
I think that the EU debt crisis will probably have a bigger effect on the dollar, but they're both fairly close. I think that the dollar, when it's all said and done, the markets run to two things: the dollar and the U.S. Treasury bonds. And if there is any trouble to be held, then the dollar will become much stronger, making the euro currency and the rest of the world currencies weaker.
All right, well, confidence remains weak, of course, due to looming tax hikes and spending cuts. Can lawmakers cut a deal in time to avoid sending the country back into recession, as some have predicted?
You know, I don't think, you know, the political system itself, I don't think they're going to cut a deal. I think they're going to, you know, they've snuck through some bills to get us through, but I don't think anything will be really done until after the election, nor do I really think that there'll be a major collapse between now and the election either. I think that we're going to be, you know, fairly status quo. We'll get a market that will trade, but I don't see a upcoming recession, you know, before the election. I think, you know, once all this starts to, you know, play out, could we have some issues? Yeah, I think there is some trouble looming if we don't get a better jobs picture. If housing doesn't, you know, it's better, but if it doesn't get much better, I think that could create some issues. But as far as a major recession, I don't see it right now.
Do you think, in other words, the markets have kind of grown to not really pay attention to what goes on in Washington and go about their businesses?
That's exactly what's happening. You know, if we look at the overall market, again, we're up, you know, 13 or 14% since the beginning of June. And what's gotten better? Earnings are worse, okay? They're less than stellar. Jobs have gotten worse. And housing has stayed status quo. I mean, I think housing's hit bottom. So in the meantime, the market's up 14%. So the market is ignoring the bad news and continuing to push forward. Now, I think that, you know, today we're kind of hearing those bubbles start to pop as you look at some of these markets start to fall over. You know, in the grain markets, in the oil market today had a big dip. So we're starting to see some of the things happen, and there could be a big bubble here, but I don't see a recession anywhere near, you know, in the next couple of months.
All right, you talked about commodities, oil and grain prices. Where exactly do you see gold and oil heading in light of these central bank policies and other factors around the world? You mentioned that crack in the commodities market today. Is this a downward trend you're seeing here?
Well, if we look at the grain markets first, the grain markets had been super high and had been, driven by so much fear and panic that they were reaching what we would call a blow-off scenario where buyers didn't care about price or time. They just had to get in or get out. So now I think that the commodities have finally settled. We're aware of what the crops are going to look like. We're aware of the fear. And I think that the commodities are now going to start into a downtrend. I would be a seller of every rally in the grain markets. Oil is a mystery in its own right here. As we broke through that $98 level on the way up, and now we're back around 95 today, I think that you're going to see there's a glut of oil. There's plenty of supply. And I think that the driving season is now over, so we're going to see that start to head down. Now, as far as gold, the monetary policy, if they continue easing, gold is going to go higher. Now, I could see gold going, I would see 1,800 right here on the top end for the time being. I'm not really looking for gold to go much higher because I think that this will start to play out as we go forward. And I think that we're going to find out that this easing is not a very good philosophy. And then we're going to start to see some more strength in the dollar, which will automatically, in nature, weaken the commodity markets.
All right, well, you mentioned oil prices. How seriously should investors take the threat of armed conflict in the Middle East? You said there's a glut of oil, but those tensions seem to be escalating between Israel and Iran. And we've also had the recent assassination of the U.S. ambassador in Libya. Do you think that will have an impact on the price of oil?
I don't think so. I think we saw the impact last week. I think you saw the upcoming trouble. Could we have a temporary spike in oil? Yeah, absolutely. It happens, on a regular basis. We can go back to Libya or Egypt a couple of years ago. But I think overall, long term, I think it will have no effect on our oil. And I see the price of oil going lower. I could say that I would be very comfortable being short oil anywhere below $100 a barrel. I don't think we see 100 again. If we get a spike on fear, I could see that, but I think it comes right back down again.
A lot of commuters probably feel somewhat buoyed by your assessment there. Now let's talk about some other perhaps sleeper asset classes right now. Are there any you're looking at that some are maybe better to climb than others?
I think what you have to look at right now, just in general, the markets themselves are quite a bit higher than they should be, in my opinion. I think if you're an investor, you really have to be observing the different markets that you want to look at. I don't see any great investment opportunities up at these levels. I think you want to wait for some sort of regular pullback where we would get a natural correction in many of the indices that are performing and that are on 5-year highs now. Now, one of the problems with that theory is that many of the experts are now waiting for this dip, and I don't think that they're going to be lucky enough to get it. I think they're going to force a lot of these funds to jump in up here and overpay, and then I think we get a reasonable 5 to 8% correction in the market. So that's what I would be looking for. I am not at all a player in this market until we get some sort of 5 to 8% correction.
So in other words, there's no doubt in your mind eventually there's going to be a correction, whether it's sooner or later.
Yes, sir. 100% in my opinion, there will be a correction. And we could go, listen, we could run to 1,500 S&P before. That would not shock me. But as far as putting new money in, I think the risk is by putting new money into the long side of the market out here. And certainly it would be irresponsible of me to say that it would be a good spot to get short, because the tape is telling you that the market still wants to go higher right here.
Well, in the past, we've seen the role that politics can play in the stock market. We wanted to ask you, how should investors play this upcoming presidential election, or are they just better off waiting it out?
I think you wait it out, but I do believe if we get the dip that I'm looking for, I would have no problem in buying the market down there. If we got a spot to get short the market where I could find a reasonable level, I would have no problem. I really believe that the election itself will have very little effect on the overall markets, and I would be willing to trade the technical patterns of the market no matter who wins the election or no matter how it plays out.
All right, excellent. Todd Horowitz, Senior Strategist for the Adam Mesh Trading Group and author of Average Joe Option. Todd, great talking with you again. Thanks for being with us.
Thanks, John.